This stupid simple strategy made me over $3 million trading. And this is what ICT had to say about me after my large payout.
Ask Lanto how he gives a f***. That motherfucker's making bank. Ain't nobody on the f***ing internet can say otherwise. They can't do shit. You ain't gonna hear me say shit.
And I'm gonna be able to do what Lanto's doing. You're killing it right now. So well done, young man. Very, very good.
He could have came out and said, F*** you ICT. I did this with market profile. Well done, motherfucker. There you go.
And today, I'm breaking down exactly that in 3 simple steps. By the end of this video, you're gonna understand exactly how I approach every single trading day. Step 1, higher time frame bias. How I'm blocking out the noise and finding my bias. Step 2, overnight price. How I utilize Asia and leaded sessions towards my advantage. And step 3, the opening range move. This is where the moneymaker is. Throughout the video, you'll see real examples broken down that I took with my community live. So let's begin. All right, so now that we're on the presentation, let's get into it. The opening range move trading strategy. Higher time frame analysis. Why higher time frame matters. Markets operate through liquidity. The largest inefficiencies matter the most. Higher time frame gaps, highs and lows override 1-minute movements. The higher time frame framework. 1. Identify gaps or inefficiencies. Essentially, we look for fair value gaps or liquidity voids on the hourly, 4-hour, or daily charts. Mark key higher time frame highs and lows. Swing points act as magnets for price. Mark them clearly. Number 3. Watch price target these on lower time frame. Wait for lower time frame 1 and 5 minute to approach these key levels. And number 4, execute when confluence aligns. Enter only when time and price agree. So looking at this visual here, on the left, you have your higher time frame look. On the right, you have your lower time frame look. Essentially, your higher time frame look shows you a sequence where we come down here, take out an area of sell side liquidity, for this example being this candle wick low. Then we end up seeing through higher time frame price coming back up and seeking that buy side area of liquidity. Through lower time frame, you could see that price was still operating the same way, except through the smaller time frame, we end up seeing price come down here, take that exact sell side liquidity, then seeing that push back up. This is the alignment you want with higher time frame and the significance of higher time frame. When you're able to more so match your higher time frame look with your lower time frame look, you're able to get an A+ setup. Blocking out the noise. Identifying quality fair value gaps and inversion fair value gaps. A good fair value gap has a strong displacement sequence, takes previous liquidity, and it has clean candle bodies. A bad fair value gap has large wicks, small bodies, minimal gap size, and also trading inside of consolidation. What we're able to see on this visual where we have 2 components line up here. On the left, you have a gap where you seek large displacement in the body of the fair value gap, right? You also have an area of liquidity, being your buy side liquidity, where we see price come into, take out that level, and still seek higher expansion. These 2 components are large for blocking out the noise and marking out the best fair value gaps and inversion fair value gaps to trade. I used to always get the best fair value gaps wrong all the time, not knowing which fair value gaps to mark out compared to others. As you guys know, there's a ton of noise in the market, and it can be very frustrating knowing which fair value gap the markets actually respect. And with these 2 components here specifically, large displacement and the liquidity taken aspect, what you have here is clarity, and this allows you to not only develop your higher time frame bias, but also allows you to use these components for your lower time frame entries. So looking at these 2 visuals, we have a good example here, and we have a bad example here. We already explained the left, but basically on the right, the reason this is a bad fair value gap is because this is a fair value gap where you see large wicks being formed off the previous candle high and the next candle low for a bullish fair value gap. And you also see no liquidity here as we did here in this buy side area. So we don't take liquidity, nor do we have a good displacive sequence in the creation of the fair value gap, leaving a good void and inefficiency in the market for price to come back down and truly respect. Now, if we're able to go to TradingView real quick and look at this chart, what we're able to see is an hourly time frame, a higher time frame look where we simply have price action. Now, in order to mark out my higher time frame look, as mentioned, one key component are swing points. Swing points for me are essentially key areas in the market where we make large wicks before seeking reversal. So let's go ahead and mark them out. For me here, there would be 3 key levels. 1 being this external high, which was the high that created the ultimate reversal in the market moving back down. 2, you would have your internal high right here, as this is a key point where you see price put in a good high, wick, and then come back down. And 3, the obvious and most important area, in my opinion, is this low right here, because this is an area where we end up putting a good wick and seeing a very sharp displacement sequence back up. So with this example right here, we don't need to mark out inversion fair value gaps or fair value gaps for the hourly and the 4 hour because we already have our level points. And that's all we need to do for higher time frame. Simply mark out your key levels, aka swing points, and also your imbalances, aka fair value gaps and inversion fair value gaps. Number 2, Asia and London sessions. These are 2 sessions I use that are overnight price that I really find super helpful. If you trade RTH, RTH stands for regular trading hours. That's essentially where you only trade the New York data. So like a SPY, like a QQQ, that is typically RTH where you only have New York data. But when you end up using Asia and London session, what you're able to do is collect 23 hours of data in the market a day. So it's essentially like you have more pieces to the puzzle. And so when you have more data in price action, you're able to get a lot clearer of a picture in what price is trying to do. So session time zones, EST. I have it for Asia at 6 p.m. to 3 a.m. I have London from 3 a.m. to 9:30 a.m. And then I have New York open from 9:30 a.m. to 4 p.m. Identifiers. Bullish expansion. Takes high and higher movement. Bearish expansion. Takes low and lower movement. If we take a quick look at this chart right here, what you're able to see is you're able to see an external high being put in. Then you're able to see a swing point through the higher time frame put in, which also acts as a lower time frame internal high or internal draw. So as we talked about the identifiers, we have our bullish expansion and bearish expansion. But now I want to introduce the golden zone. This is where you have your higher time frame and session alignment in one. This is the A+. So the 3 things you need to do is 1, mark out a higher time frame level, gap, high or low. Identify the major draw on liquidity from higher time frame. 2, Asia/London takes out the higher time frame level. These sessions act as the setup phase for manipulating price into the zone. And 3, look for reversal confirmation. Wait for a lower time frame market structure shift inside the zone. So what we're looking for price to do here is we're looking for price to come up on a key higher time level for a bearish setup, and then a key higher time frame low level for a bullish setup. What you want to see is you want to see price to the bearish setup come up here and take that area of liquidity through London and Asia. And then you also want to see price on the bullish setup come down here and take that area of liquidity through London and Asia. So what that allows you to do as New York primary traders, right, is you're looking for a move through overnight to be able to clear up some liquidity through higher time frame to be able to gauge a much easier bias coming into your New York Open. Execution case study, analyzing a higher time frame low. This chart illustrates how a higher time frame low acts as a magnet pull for liquidity before the session move. Key observation, notice the sweep of the higher time frame low before London Open. Displacement following the sweep confirms the bias shift. What price to do here essentially is come down, take out that area of liquidity in that sell side, then see that shift back up through that overnight session. So for this example, you would have this sequence right here where you see overnight price come down, take out the liquidity, then see that move back up. And so via lower time frame, this visual represents what your lower time frame would look. This being a 5-minute time frame chart, you see price come down here, you see liquidity being taken, and then you see a shift in structure via price. And so for this second component, that's all you're looking for. Let me show you how to do it on the chart. So after marking out our higher time frame narrative, what I'm looking for price to simply do here is move into one of these areas of liquidity. From there, we could then seek our reaction. Let's see how this goes. Okay, so after fast forwarding for a bit, we're able to see that price came down here into this area of liquidity where we see price come down here and tag out this major area of sell side. So now with using step number 2 in the Asia and London session, what we're going to do here is scroll into the lower time frame and simply observe how price reacts once after taking out its swing point on the hourly time frame. And as we showcased on the example, you want to see price take out that low and then simply displace back up, showcasing some type of bullish movement. So let's fast forward a bit and see what happens. So after initially seeing price action come back down here and take out the swing point, we then see price come back up and we see price showcase a bit of structure and bullish displacement. This is important for the next step. Now, if I'm being honest in this example, this isn't the most bullish displace. What you ideally want to see price do is really engulf back up, but this is enough where this tells you that price potentially wants to seek higher. Again, potentially, we don't need to do anything yet here. We're simply still observing. So this is step number 3, and by far the most important step. the opening range move. What is an opening range move? First move into an area of liquidity, typically a London/Asia session high or low, where price confirms interest or no interest in bias. Targeting, observation, the ultimate draw marked on the chart. That is the final destination for the session expansion. The hidden rule: if consolidation after ORM, do not trade. So up until this point, what we've done so far is marked out our higher time frame narrative through our swing points, our 3 swing points in the example, and we end up seeing price through Asia and London come down and take out that major area of liquidity through the sell side grab. And then we end up seeing price showcase a bit of bullish displace off the low, indicating a potential reversal in the market. Now, this is where it gets juicy. And this is why the opening range move is the most important part, because up until this point in time, what we've done so far is we've seen price kind of come down here through our higher time frame look and end up taking this big area of sell side being the swing point. And then what we end up seeing overnight price do after taking out that low is showcasing a bit of bullish displace back up. The opening range move is so key because off our New York opens, we could either see price come down here, attack the lows, potentially seek a move back higher, still being bullish, or come back down here, attack the lows, and look for lower, simply creating a lower high and seeking expansion lower, which would completely dissolve the idea behind the reversal here. Or we could see what happens here in this example, where you see price come off the open and showcase bullish displacement off the get-go. You see price come up here, you see price attack that internal high, and then you see price eventually go into that ultimate draw. And that is what you want. So if we go back to our example, what we're able to see is we're able to see price action a bit before the opening bell, just about 10 minutes before. We end up seeking the bullish displace off the low, and now simply what we're waiting for is we're waiting for the opening range move. Like I said, we have one of two reactions. We're either bullish or bearish off the opening range move. We either see price come down here, attack this low, and then you see that point of reversal back up, building that structure, or you see price look to come back down, attack that low, and only look to seek lower expansion. So let's see what happens here. And there is your opening range move through New York here. You see volatility pick up, and you see our first move into an opposing liquidity, typically an overnight session high or low. Then you see price come back up here. So for this example right here, the trade that we ended up actually taking here was a trade I ended up taking with my Discord community live. And here was the trade. After seeing all our components and utilizing the opening range move, what we did here was we looked for a continuation in the market. So here's the trade setup. As mentioned earlier, a great way in where you mark out your fair value gaps or inversion fair value gaps are gaps which are larger in displace than the others, or gaps that took liquidity. Unfortunately, price wasn't great that day, so the best gap in sight was this 1 minute gap here, which is a gap that came off taking liquidity just a bit before, and also a gap which was the larger displacement in zone. When we're simply looking for continuation after seeing that reversal in play off the opening range move, giving you that indication to take a trade after everything, all we're looking for here is a clear entry. We eventually end up taking this trade where you end up seeing me exactly say when I go long with my community, and we did. So after taking a long, and as I mentioned, all I was doing for this trade was simply targeting opposing liquidity. Let's see how this goes. And boom, there is your take profit. A very successful trade where we simply end up utilizing all our components with how we end up marking out our bias, then seeing confirmation, and then simply looking for continuation on forward. So here's another example in the case that you didn't really find it super clear. For this trade here, I will be showing you guys a short that I ended up taking with my community. So if we start off with our first component, if you remember, marking out our higher time frame swing points. So for this example, you had your key point of reversal being this swing low right here, as we see a large wick before reversal back up higher, taking liquidity. And this would also be your swing point here as well, because this is a large wick where we see reversal after taking out liquidity. And these are two big external levels that we end up marking out. You don't need to be as wide with these levels, but these are the examples I'm using for today. And so now from here, all we do is stay patient and simply wait for price to attack either the high or the low here. And boom, there's a level being attacked. We end up taking out this high right here specifically. And so from here, all we simply do is wait for the reaction through our overnight price sequence and showcasing a potential bearish rejection and reversal lower. And boom, there's your bearish displacement. We end up marking out a higher time frame high. We end up seeing price come up here and take that high out through our overnight sessions in Asia and London. Then we end up seeing London kind of come back down here towards the tail end and showcase bearish displace. What that clears up for New York is a simple bias look where we either confirm off the opening range for lower, or we end up seeing price shoot for higher, which we completely then void. Let's see what the opening range move does. And boom, there is your clear opening range move. Like example one, what we end up seeing price do is come up here, tag out this London high, then you end up seeing reversal back down, now taking out that liquidity that we ended up putting in through our overnight session high. Now what we simply do is mark out the best fair value gap in sight to go short off, and we simply look to ride continuation. So for the best gap in this example, what you're simply looking to do is simply mark out this 5-minute gap, go here. And that is because this 5-minute gap is clearly the most displacive and also the gap which ended up taking liquidity in this previous candle high. So now we've identified that and we've seen price displace, which is key. All we're looking for price to do here essentially is showcase an inversion sequence where we then go short. So utilizing 1-minute confirmation with our trades, what we're able to see is price come down here and eventually go invert off that 5-minute gap at 9:57 a.m. Eastern Standard Time. We then take our entry, put our stops in, put our TP in being a slotted low. Let's see how this trade pans out. And boom, there is your take, profit smashed. We end up utilizing all 3 components and seeing an A+ move and an A+ setup. So that was your 3-step framework. Higher time frame analysis, overnight price, the opening range move. Simple, but effective. If you want to see this in action every single day, I trade live with my Discord every single morning. Link in the description. And yeah, drop a comment if you want me to go deeper in any of these steps. And if you like this video, subscribe. We got a lot more coming.